Okay, we should be live. So this is Trading Homework on March 14th, 2021. I'm John, and I'm here with Chris, Sell the Fucking Rip Trader.
What's
Got
up?
our Twitter handles on the screen, so you can follow us there. And we got a lot to cover. We got ready up for next week.
Yeah,
So big deal is the quad witching, right? The options expiration across a whole different or a whole bunch of different calendars.
that's. Oh yeah, that is Friday, ain't it?
Yeah, and so the first trade idea for next week that I want to talk through is based off of that timeline
Uh,
dovetailing with the bounce in ARK that we saw last week. So I think that's kind of setting a new range.
right.
I think we're probably going into a period of volatility contraction for ARK, at least for a couple of weeks. And so I got a exciting trade idea to cover on that. So can we start with that? Are you okay with that, Chris? Or you got anything you want to put on the schedule? Or
Not right at the moment. I'm adding a few people to my room, my Zoom over here. So
cool.
you just go ahead
Okay.
and I'm
All right.
trying
So
to get
can
some
you see
stuff
my
set up.
screen, Chris, on
Yes, I can.
on YouTube? Okay, great. Um, so what I have up here is this is a complex combo. It's an options combo on ARK. It expires in 2 weeks. And my thinking is that next week is going to be pretty tame because um, the options expiration pinning that we'll see, I think
Right.
it's probably going to have it's going to keep the price movement kind of muted. And so this is a strategy that, well, maybe strategy is the wrong word for it. People call these options strategies, but it's a combo it's essentially a premium selling combo, and it's two different strategies combined. So what we're looking at here on ARK is I've got it up in a window here, what all the legs are, and there are different quantities too. So these are ratios. So let me just mention a few things about this. So we see, first of all, here's what this is. This is an iron condor combined with a butterfly. And so by doing that, the iron condor, you could see that it's got half the shape of an iron condor here, and the other half kind of looks like a butterfly. But normally with a butterfly, you're going to pay a debit for that. However, for this one, as long as it's within this range, which is a really wide range, it's actually like 10% to the downside and 10% to the upside. If ARK settles in 2 weeks' time within that range, this is favoring the bull side. So a move higher in ARK. Let's see here. I put this at 136, which is 9 points higher than where it is right now. It's at 127.
Mhm.
So if ARK is 9 points higher in 2 weeks, that's the max profit on this trade. And then if it runs much higher than that, sort of like selling covered calls, the profitability of it just gets whacked. If it blows through the top end of the range of about 139, if ARK goes above that in 2 weeks' time, then it can turn the trade into a loss. And of course, if it falls more than 10%, that can also turn the trade into a loss. There's a few things you can do to manage this position. Is you can roll out these call sides. If you roll these out, you got some music,
What
some
is
echo or
that
something.
noise?
Here, hang on a second, Chris. I got you, man. There. So I just muted you for a second, Chris, while you get the audio issue dealt with. He's got some back end process going on his.
Okay.
All right, you back. Wait, no, it started again. Okay. All right. So a few things about this. You can roll the call legs, or mostly just this middle one where you're selling three. that's this point. And so, yeah, I hear it, Chris, but I got you muted, so it's not playing through the stream. No, nobody can hear you right now. Yeah. You might be able to hear it through my speaker a little bit. Hey, Chris, can you mute till your mic till you get it sorted? All right. So yeah, he probably had like a tab open or something. Anyways, by rolling this the contract that we're short here with the 3. So if it turns out we get closer to expiration and the price looks like it's going to settle away from 136, you can actually roll this.
Broadcasting, I see 3 of you right now.
Yeah, I think it's because of the Zoom.
Okay.
Oh, I see what's happening.
I'm looking at you on
people are
YouTube,
joining,
man.
and maybe it's their audio.
I'm looking at you on YouTube.
Okay, so there's a few people in the Zoom. It's their audio. You might have to.
Okay. I muted all of them.
Okay, yeah, cool.
I muted you by accident. Oops, wrong guy.
Okay, how about now?
I am about to kick these guys if they don't stop. That's it. You're
out. You might have to password this Zoom, Chris. Oh no, he kicked me. All right, here's what I'm gonna do. I'm gonna reconnect to. I'm sure he's setting up another Zoom, so I'll watch for that when it gets set up. Hopefully he'll password it. Sorry for that. So anyway, what you could do is the peak profit on this trade. Hey Chris, by the way, if you're watching, just send me another email and I'll rejoin the Zoom. You might want to put a password on it though. All right, so anyways, you can roll this around. And I showed yesterday how to use the roll tool. So if you have this on, you can see over here I have a combo. This is just a bull call spread. If I want to roll one of the legs, I right click here and I say roll, and that'll roll that leg. And so what you can do is you get closer to expiration on this trade, you can roll this leg around. However, what you need to know about that, all right, Chris sent a new Zoom. What you need to know about that is it can change the margin impact. So, all right, let me get joined up here. Join without video. Join with computer audio. Hey.
Shit like that.
Yeah. That's crazy. Maybe you made some enemies, dude. I don't know. But anyway, yeah, yeah, we're probably good now.
I don't even know who those people were. They were just.
Yeah. If it's not passworded, maybe it's.
Okay, I got lists now. I got words. They kept saying up communism, up communism. They were communists.
Oh, okay.
That's all they kept chatting was up communism.
So it's just some hackers or something join in. All right, no big deal. So Chris, I was just explaining that on that combo, like I have a lot to talk about with this combo. So essentially, like as you get closer to expiration, you're gonna want to try and keep this strike where we've sold 3 contracts. You want to keep that out of the money, and so if you have to roll that around, like if the price fades on you, if ARK falls, then you're gonna want to roll this 136 position.
3 screens, man. I see 3 heads.
Yeah, well, that's Yeah, I'm not sure why that's happening. It's because you have YouTube up. Your screen is showing YouTube. That's what's going on.
Well, there's 3 of you, so I shouldn't see.
Okay. Well, you won't now. I just minimized Zoom. All right. Sorry for the logistics issues.
Sorry.
That's all right. So you can roll all these calls as a group if you want, but the most important ones is to roll this middle one, the sell 3, and then and this buy 2. And the reason you need to roll both of those is because you can get margin impact if you don't do that. So if you watch this, if I change this to 137, it's fine because I just moved it closer to these protective calls that we bought. But if I move it to 135, then you'll see that the margin impact goes up a lot. It actually now took 50% more margin for the position. So that won't happen if you roll these protective calls in as well. And so I'll show that. So if you do that at the same time, and we'll go, oops, what did I have that at before? It was 140, right? Let me put this back because I wasn't paying close enough attention. I think it was 142 is what I had. Yeah, there we go. That's what it was. So if I have to roll this in to 135 and I don't want the margin impact to go up, you can roll these also like that. And you probably actually also have to roll that down. So yeah, if you roll all these calls together, the margin impact will stay the same. And also interestingly, by rolling these calls lower, that it may bring in a credit. But maybe not. So it just depends on where the price is moving. So let me flip this back, and we'll talk about the different components of this individually. So I mean, this is like premium selling on steroids, by the way. I mean, what other premium selling strategy can have this kind of return where up here it's returning over 100% on a premium selling strategy? Hey, do I still have your audio, Chris?
I'm just being quiet
because you're talking and everything fixed itself.
Okay, cool. Yeah, I got you. I had you muted on the stream. I unmuted you. All right, so let's look at the individual components of it. So this is like premium selling on steroids. Like what a lot of people are doing is they're selling strangles, or they're putting on iron condors. I like this a little better, where I have a bullish outlook, and also my view is declining volatility, because you can make just crazy gains with this quickly. The other thing that I'm going to do with this, by the way, next week, is I'm going to be putting these on Monday. I mean, they're just $600 a pop, and I'm going to be putting them on Monday, Tuesday, and Wednesday probably. For this same expiration. I don't know that I'll use the same strikes every time. Like if the market is strong, I'll push these call strikes higher. I may push all the strikes higher. If the market is weak, then I may use lower strikes. And so what that'll kind of do is build a super position that kind of averages around a max gain in this area. And so if we look at, let me strip out the butterfly first, and let's look at this just as the iron condor elements of it. So I'm going to get rid of that call purchase, and then we're going to drop the quantity here from 3 to 1, and the quantity here from 2 to 1. Okay, so now this is an iron condor. See, it says it right there, even iron condor in the window. And so the premium it makes is pretty good. It's still got the same margin impact. Hang on, let me reset this window. So it still has the same margin impact of 600, and it makes a fat premium. However, if in that bullish scenario, it doesn't make as much. It also has a slightly lower a top end here. The break even is slightly lower. So anyway, now let's look at just the butterfly, which we put on. It was 136 was the ones we were selling. So let's put on 2 of those. We cleared the puts off of there. And we need to buy a 132. No, I'm sorry, it's a 130. Okay, so there's the butterfly. And the weakness of the butterfly is it's a debit. Like, you have to pay up to get this thing. And also, you have to be super accurate. Like, this is, it's like you're aiming for the bullseye in darts. It's pretty hard to get these to connect. And so the reason I like combining them is because you could still put the trade on as a for a credit, and you've got all the upside of the butterfly. In fact, it's actually even more upside at the peak. If you notice, like here, for the same, I take that back. It doesn't have another advantage of the butterfly is that it is a debit for $132 in this case. But the margin impact is 0. So you could put on a whole bunch more of these. You could put on like 4 of these instead of 1 of the other kind of trade for the same money. So let's rebuild this thing. And let's see, what do I need to do here? I need to up this quantity to a 3, up this to 2, and then we need to put on the notice that the margin impact just for the call side of this thing is 600. Okay, and when I put on the put credit spread, it doesn't change the margin impact. So we can essentially put on the either side. If you have one side on, you can put the other side on for free. As far as like the margin impact goes. So the max, let's talk about the max loss on this, and then I think we'll be ready to move on. So the max loss on this, we need to step through the calendar too a little bit and play it forward in the simulator. So the max loss is the margin impact minus the credit. And so that's why it's saying the max loss is $525, because it's assuming that you're going to pay this commission. You're going to get this credit, and you're going to have this margin impact. So if you lost all the margin impact, you still had a credit, but you had to pay commission too of $14. So that's what it's doing. It's taking that minus $61, and it's here's how it's arriving at that. It's this 75 cents ask. It's assuming that we're going to have to pay that ask on the trade. Now I'm going to try and get this executed as close to midpoint as possible, which is probably going to be around $1.50, I think. And so if I could get it for $1.50, what that does is that this whole region right here won't be 75; it'll be 150. So like if ARK is like flat or down slightly, 2 weeks later, then instead of $75 profit, it'll be like $150 profit. So that's nice. The other thing that it does is it reduces my max loss. So if I can get this for $1.50 credit, then my max loss will be $450 minus the commission. So I mean that to me is outstanding. So I'm really excited about this trade idea. One other thing, let's play it forward on the calendar here. So tomorrow, when I advance it one day, I'm not exactly sure why, but it actually looks like I'll be able to get it cheaper at the current price. So it's saying that due to some kind of time decay playing out, that this particular combo will be $57 cheaper at the current price. So another reason to average into this is because as the price moves around tomorrow, it's going to be sliding along this dotted line. And so sometimes it gets cheaper, even though it's like long-term more favorable. So like, if the price moves slightly higher for ARK, this combo could lose money. But that's okay because watch what happens. Like if we go to, this is 2 days before expiration. See how it got pulled up now? And what was underwater and cheaper is now in a profit. And if you go to day before expiration, look at that. It's pulling real hard towards this peak. And so on the last day, it's just going to look like this. And, not right away, but by the end of the day. And so what you need to be careful of is if you're not right on this peak, you're going to find that it's at some point it was going up in price, the value of the combo, but then it starts going down. So like it may actually be temporarily above this line and then fall down as it comes closer to the close. So anyway, that's the ARK premium selling super move. Any comments there, Chris? Or so one thing I'll mention is I use these premiums I collect with this kind of stuff to be putting on like 1-inch punch trades elsewhere, things like that. If the market tanks, I've got a bonds position. I've also got put walls out there on HYG and stuff like that. So if the market tanks, then I'm not too worried about things. Chris, do I still have your audio?
Yes.
All right. Any comments here before we move on? Or are you ready to go?
Nope.
Let's look at the ARK chart. So I didn't explain how I'm picking these strikes. So here's ARK, and that's the daily chart. If you look at the weekly chart, let me make these bars bigger. 7, sure. Okay, hopefully that's easy enough for people to see. So ARK was up 8% last week. I think it's going to be probably not up more than 3 or 4% next week because of the options expiration. And I think the following week isn't going to be up more than, say, 5%. Just a guess. I think ARK is going to be drifting into some resistance to these moving averages. And it may move back into like a normal kind of a rise where it's just like, riding short-term upper Bollinger Bands higher.
What is that, in between the 50 and the 200?
What's that?
Is that in between the 50 and the 100? Sorry, I said 200.
Oh, yeah. It's between. So it just got above these are weekly moving averages, though. If we go to daily, yeah, it's like trapped under some key moving averages here. The 50-day moving average is stuck under. So if you notice, like that's my price target is right there, right where that 50-day moving average is. The price target right there.
Yeah, I see it.
136. Yeah, I'm looking at max profit in 2 weeks at around 136. So anyway, that's how I'm.
You're
picking
looking for
these
ARK
levels.
to go up.
I'm looking for ARK to drift up, not explode higher, but go up
Right.
like inside of a normal range. Yeah,
Huh.
and so this makes a lot of money in that situation where it does that, and it does it in a premium selling way. So I mean, I have a broad range here, minus 10% and plus 10%. Like if I zoom in on this, and you look at just the 10% up and 10% down. I mean, almost the entire thing is above the zero line at expiration, and mostly with a slightly upward bias. So if ARK is up like 5%, this trade is going to make like 50%. For my margin impact. For every 600 I put up for a combo, I'd be looking at $300 right there if it's up like 5%, right there.
Right.
Let me go to expiration and then we'll have those numbers. Yeah. So I mean, if ARK is up 5% at expiration, and by the way, I'm trying to get it for a better credit than 75 cents. So these numbers are based on 75 cents. I'm trying to get it at 75 cents or $1 better than this.
Mm-hmm.
So anyway, I mean, it just could be tremendously profitable if ARK is up 5%.
Right.
So that's the idea. And so by putting these on, though, I'm using this to these credits to fund other trades. It's the kind of stuff that we're going to be talking about later on. I've got a watch list to go through. But anyway, I've been talking long enough. You want to tag in and cover anything?
All right. So I was looking at actually when while you were talking, I was trying to figure out what the hell just happened. I found out that there's some communists that like to go into
Crash Zoom.
people's Zoom meetings and destroy them.
Yeah.
That was awesome. So the first thing I was looking at was the spiders. So, we were headed well on our way down overnight on Friday, right? Going down the way I thought we would. And all of a sudden at 5 o'clock in the morning, it hits a spinning top on the hourly, and it takes off like a bat out of hell from there. And I'm kind of getting a little aggravated with this move. It does it almost every single morning that there's that, the market's recovering from a bearish thesis to a bullish thesis. I mean,
yeah, and there's lots of stocks that are breaking out right now, and it's different names. Like a lot of those tech names are wrecked, but I mean, there's a lot going on. I've got quite a big list.
Right, and I'm looking at this.
So like the knife catchers got their bounce. Like that's what happened last week.
I'm sorry?
The knife catchers got their bounce.
Oh, yeah. Yeah, they did. It was that was the beginning of last week, yeah.
Yeah.
And we are near all-time highs again. And I don't believe we deserve to be up here. So on the hourly chart of the SPY, I am seeing a top here, and I'm seeing a top here. And I think what we're going to do is we're either going to retest this level or we're going to retest the 395 in the SPY and then go back down from there. I am watching, you can't really tell that much, but I am watching this little double top right here.
Yeah.
In the RSI. So I'm thinking that this might be the limit and then it's going to go down. I don't know. I see that the market's trying to eke its way up, but I have not been thrilled with the way that the market's been acting for the last week.
Yeah, well, and volatility didn't really catch up to, and by volatility, I'm talking about the VIX complex, didn't really catch up to what really it looks like it should have happened with, all the damage done on the NASDAQ and with ARK and stuff. These
right.
Other now, things have been so strong, like reopening theme, the financials for a different reason, because of the interest rates blowing out on the long end on the yield curve.
Yeah, they didn't get affected, but I went short financials on Friday. So I have the VIX up right now.
All right. Hey, we've got a chat message. Michael Irizarry says, I bought 1,000 shares of UVXY. I will be rich next week, he says.
You might be.
Yeah, maybe. Yeah, this thing is like swooping.
You very well might be. I actually went long VIX on Friday as well. Because I do see volatility coming back. So, and the reason that I see volatility coming back, could you try and refresh that?
Oh.
Because I'm looking at SPY on the YouTube.
There we go. Sorry. Yep. It should catch up now.
All right. So, I have my purple dotted on the top and I have my purple dotted on the bottom.
Yeah, so essentially that's the range.
Yeah, so we're down in the purple dotted again. And we just got here. So what happened the last time that we just got there? We spent a little time down there and then we started moving. So from there to there is 3 days at a move of $3.
Mm-hmm.
So if things change, if all things stay the same relatively, well, for just for argument's sake, we'll say 3 days, and I said what, $3? We'll be
Yeah.
at 2350 ish. Now that's not saying that it's going to happen, but that's my play.
Okay. So going into options expiration week, this is the monthly expiration. It's also the end of the quarter. And so I'm looking at that to keep volatility suppressed like through this week, which is another reason why, I picked with the ARK thing that, I'm looking for. And it doesn't have to happen this way. Sometimes they ramp volatility into expiration.
Uh-huh.
But I don't really expect that right now.
I hear you. My meeting's going to end in 10 minutes. All right, fine. I've been putting this off for a while. I may as well do it now.
Okay. Well, I mean, yeah, we'll just reconnect once it's done. Yeah, if you want, if you got some setup stuff to do, I can start going through the
Yeah,
some of the
can you
watch
go
list.
through some stuff, and I'm just going to take care of this real quick.
All right, cool. So,
No time like the present, right?
yeah,
Do me a favor. Can you talk about the dollar? Because I
yeah,
want to hear what you have to say about the dollar while I futz with this, and then I'll come in with what I got.
yeah, that's a good thing to cover. USD. I mean, it was up last week, kind of, but it looks like it just looks like it's range bound to me in an uptrend. There's like a really really slow up channel. I mean, the dollar is always going to move slow. It never really moves fast. Let's zoom out on this. I mean, it looks like it carved a bottom, and it's now like making trending higher, and eventually that's going to wreck a lot of stuff. But I don't know that that's imminent, though. I mean, the last time we got a stimulus, it smacked the dollar, right? So that was right here.
That's what I was
giant
expecting.
down red candle right here in March of 2020. That stimulus happened, and it caused this like big red candle. We're not seeing anything like that kind of volatility now. I think that the market is, for the most part, priced in a lot of the stimulus that we currently have. And so the sibling trade to the USD is TLT. I mean, look at this on the weekly chart. I'm glad. I mean, I should have just went short instead of put on a back spread on this thing. But instead, I've just been like resetting a back spread all the way down and just bleeding out a little bit of time decay. So I have a ratio back spread in TLT for calls. And so what that does is essentially like, pushing down a spring. When this thing has a bounce, and where something that we had talked about, a level where it may bounce, is this purple line here has always been a long-term support. This purple line is a 50-month moving average. And right now it's at 130. TLT is now at 136. It was down, 3 points on Friday, or was that Thursday? I think it was Friday. Shocking gap down.
Friday, yeah, it was a gap down.
Yeah, and so, if this has 6 more points lower before it bounces, I mean, I think when it does bounce, it could be really, really big. So, I mean, it doesn't have to. Like here, we saw a big drop, and it just like drifted higher really slowly. But this to me is acting like a market that wants to bounce. So here's an example in 2011 where it rocketed higher. But there was a reason for that. There was a European financial crisis around the corner. I don't know that we have a driver for that there. But I mean, look at how strong TLT was in 2019. And that was in a scenario where the Fed was they were lowering rates in 2019, the short rates. So we may be getting to that point where they cry uncle on rates. I mean, I think by the time TLT's at 130, I'll have rolled that back spread so many times, but I would have been better off just being short, or you had a put back spread on instead of a call back spread. I would have made a lot of money if I did it the other way around. But
yeah, when it hit, and I'm not done. I'm still typing stuff in. When it hit that 143
yeah.
and pulled back, I was like, "You son of a."
Oh yeah, because it like ran out of gas so quick.
Yeah.
Yeah, and I think that's because the stimulus is a really big deal, and it went through on Friday, right? Like that's when it was actually signed. And so the market had a little mini fit, a little puke from that.
Right.
But now that's over. So what's the next catalyst for this thing to keep grinding lower? I'm not sure what it would be. And in fact, what I'm looking for, I think what a lot of people are looking for, is for the Fed to do some shifting around of where they're buying and where they're selling along the yield curve. So, I'm looking for the Fed to lighten up on the short duration and pick up their buying on the long duration, the long end, or just shift to longer duration.
Right.
I don't know if they're going to do that though. They may not. So what's happening is the secondary market is basically crying foul about all the stimulus. That's what this really, really ugly chart looks like. And the higher these rates go, like it's tugging gold down too, ironically. At least for now. It has been. Like these are very similar looking charts. But GLD looks like it's kind of making a bottom. Also interesting is the gold to silver ratio. So let me bring this up real quick because if you have a whole bunch of silver bars or 1,000-ounce silver bars, you might be thinking of going in and trading those for gold ounce bars. Because if you were buying silver bars when the ratio was 80 or higher, and a lot of people were, that ratio was really high, like 100. I couldn't even believe it back here last year when it went above 100. That was just insane. That to me was as crazy as negative oil contract prices. But so anyway, like if for people who went and got silver bars here, all right, unlimited minutes, cool.
Yeah, that's done now.
So for people who are buying silver here at around a 110 gold to silver ratio, they can now get twice as much gold than they could have had they just been buying gold at this time. If they take their silver bars and swap them for gold when the ratio's at 65 range.
Okay, where are you at? Gold, silver. Okay.
Yeah, they can get almost twice as much gold bars now as they could have had they been buying gold instead of silver a year ago. So that's wild to me. And how low can this ratio go? It can go really, really low. Back in 1979, 1980, the gold to silver ratio, I think it bottomed out at around 16. It was only just very briefly there, like maybe for a day or something. But it did get that low all the way back then. Also important to know is the gold to silver ratio in the Earth's crust. For every ounce of gold that is mined, they encounter somewhere between 10 and 16 ounces of silver. So I think the natural ratio in the Earth's crust is 16 to 1. And in fact, for a lot of history, that was the ratio. But I think now with mining technology, they could be really targeted about what they're pulling out. And I think they're pulling out, for every 1 ounce of gold, they're pulling out 9 ounces of gold on average or something. Or 1 ounce of gold, they're pulling 9 ounces of silver out on average. It's something like that. So there's weird stuff going on in the silver market that this ratio has been so elevated for so long. These kind of manipulations or interventions or whatever it is that's doing this, they only last so long. In fact, in the past, the gold to silver ratio getting out of whack because of government intervention has brought down empires. I mean, there's books written about it. It's fascinating. I've read some of them. So some stocks on the watch list. I mean, there's a lot of stuff breaking out. So the best one I found this weekend was Camping World Holdings. I just looked this up on a whim, and it looks fantastic. If I zoom out to the monthly chart, you'll see that, like, I mean, this is like a blue sky scenario that this stock is going into, meaning there's it's all-time highs and no natural resistance. So it's getting close. The way that I plan to play this one, so here's the daily chart. I've just kind of cycled through a few different time frames. The way I plan to play Camping World Holdings is it actually has a fairly liquid options market, and they have weekly options on it, which is great. So I put together a combo earlier. It's showing right here, but let's just rebuild it together. So what I'm looking to do is I'm building a, this is one of those swoosh positions, right, where in the simulator it looks like a Nike swoosh sign. So the way to build one of those is you start with a call that is 3 to 6 months out, maybe slightly longer, and you get an at the money call in the combo. So we're going to go to 42. And then with about 3 weeks to go, we want a slightly out of the money put. So I'm going to April 1st, and we're going to add a 38 put. And generally that's about 10% lower than the strike on the call, as it is here. And so let's look it up on the simulator. And so there's the Nike swoosh sign. And so what's really good about this is it's sort of like buying a stock and then putting a stop loss under it. If the stock price declines, say that it falls, let's say that, I don't know, like a few days goes by and Camping World Holdings crashes. Well, if it crashes 20%, I've only lost less than 10% on my position. And so if it goes to about right here, where is that? 31. If it gets to the 31 level, I basically all my capital is protected. And so what that lets me do is I can essentially reset the swoosh position and roll this 42 call down to like a 32 call, and then protect it with another put. Like essentially, close out this, roll this call down, and roll this put as well. And this happens a lot when I put these things on, where the market will take a shock or something, and I'll get a chance to reset at much lower prices. And so with stop losses, they work a little different. They don't put you into a situation where you have a gain at lower prices. So this is an interesting way to do it. The bad news is it's manual work to roll these puts every week. So you have to keep these about 3 weeks out in order to maintain the swoosh position. The other thing about it is you're only protecting your initial capital. And as the stock ramps, what happens is these puts essentially become worthless. And out here, and you're sliding around up and down on this as the price moves around on this curve, and it can be pretty volatile. It resembles just having an outright call position at that point. So having these puts there basically just protects your capital at entry, but you can dig in on a trade like that. The other thing about it is, look at the commission. It's $4 to put $1,000 worth of capital at work. And so, that's doing a lot with a little compared to how a lot of other people might try and trade this. So if you look at, like, let's say we look at next month out, April calls. If you go slightly out of the money, I mean, like look at the $50 strike, right?
Right.
Well, I mean, how many of these contracts do you have to do? You gotta buy like, 8 or 10 of these things to put $1,000 to work. And yeah, I can multiply faster maybe. Let's take a look. So this is, if you had like 5 or 10 of these calls, you'd be making bigger gains, but they're not protected and they're burning up on time decay fast. So that position I just showed has very low time decay, very, very low. Whereas this thing, if the market zigs instead of zags on you, you just burnt up all the capital.
Which one are you in? You in 26 or April 1st?
April 16th is
April
the call I'm
16th?
looking at right now. Yeah.
All right, I'm gonna move over to there.
So that's just like a little over a month out, and so it can be an okay thing to get these like.
What strike are you in?
50.
Calls?
Yeah.
Okay, and what's your short-term put?
I was just comparing this outright call of the 50
okay,
call
I'm sorry.
to the swoosh
So the
position.
theta is 4 cents. Yeah, that ain't bad at all. Let me get my delta. I mean my chain up here.
Yeah, I mean it is going to burn up fast though. I mean it's if you advance it through time.
There we go.
Like if the price fades on you, like it burns up fast.
Well, I mean you got enough time in there that you could save yourself.
Yeah.
And then are you going to do March 19 and then wait a minute,
you could get protection on this, but I mean I don't know. The one I'm going to get though, Chris, is I'm going to get a September. I'm going to go in here in September, and I'm going to get the 42 call in September, and then I'm going to protect it with a 38 on March or on April 1st.
Oh, wow. Okay, so you're getting
it's a very different combo.
You're getting a September put and protecting it with a April call?
No, I'm sorry. I'm getting a September call, September 42 call, protecting it with the April 1st put at 38.
Oh, you have a lot of confidence in camping.
Well, it's not that. It's by putting it on this way, it has almost no time decay. And I could sit in it for, 6 months. I mean, how high can it go in 6 months?
Right. Well, you know what? As people get thrown out of their houses because of forbearance, yeah, I guess that might work.
Yeah, exactly. and look at the base. I mean, look at the stock chart. Let me put it on the weekly here.
No, I see it. I got it.
It's a beautiful cup and handle. I mean, this looks fantastic to me. Now, I don't know that it's going to run like it did last year, but if it does, I mean, this position is going to be worth a fortune. And I like to have a lot of time on it, to let something like this run, because the reason to do it this way is because this looks like it could be the start of like an emerging new uptrend in this stock that could run for months. Like that's the idea. Like look at how long this one ran, 6 months, and it doubled, and then it doubled again, and then it doubled again. And so by putting on the position this way,
there we go.
What I set myself up to do is say the stock's up around 100%. Well, what's the delta on that option? It's getting really close to 1. And so what I can do is I can exercise the option, and then it turns into like a margin security. And, if I'm at, I've essentially freed up a lot of capital by doing that. And I can still keep carrying the shares.
I'm still trying to find the bullish thesis behind this trade. I see it in the GMI, but I really do not.
Here's another one. I'll show you another one. So there's actually a lot going on with it. So if you look at Thor, which is THO, look at that. Thor already broke out last week.
Hold on a second.
And so it's a whole sector that's just ripping right now. So Thor is another one that's running.
So it's because it's spring, right?
Yeah. I mean, I guess that's a good point too. The timeline is good.
Yeah.
So with Thor,
all right. So Thor, THO.
Yeah, the options on Thor are garbage. So there's barely any liquidity there. Bid-ask spreads are so wide, like. I'm not going to be trading Thor, but
it's the same thing. I mean,
yeah, exactly. So I don't need to trade Thor because Camping World Holdings is so correlated. You know, I mean, they're the same theme.
Well, Thor looks a lot better because it broke above the cup and handle and it's still going strong. You know what I mean?
Yeah.
And the DMI on the daily looks good, and the actual ADX is in an up. You know, it's swinging up along with the DM positive or the
Yeah.
DM
I was
plus.
disappointed that Thor didn't have good options, but, you know,
What was that?
it's
CHM?
CWH, Camping World Holdings.
CWH.
Yeah.
WH.
I think the base looks better on CWH, actually. Like when I just, you know, when I look at this, it's a really perfect saucer and handle. I mean, it's just
Yeah, I'm
it's
looking at it on the
absolutely perfect.
daily. The problem I have is that the DM plus is aiming down, the DM negative is aiming down, and the ADX is just flat.
Yeah, but
aiming down.
if it the idea here is it needs to break out in the next 2 weeks, and does that flip those metrics up? If it does,
It could.
yeah. And so if it, you know, if this thing doesn't really break out in the next week or two, then, you know, I'll just ditch what I have because I don't want to sit there burning up time decay.
Right.
And there's not going to be a lot of time decay on it, but there will be some because of that put, right? Rolling that put is not free.
Yeah, it's got dividends coming up, so that's a positive.
Oh, interesting. Okay.
Yeah, that's going to be on the oh, well, I take that back. Dividends happened on the 12th.
Oh, okay. Well, I don't know what this thing pays on a dividend, but that's another reason to exercise the options. You know,
14
if
cents.
it runs up a whole bunch, like let's say this thing doubles and maybe a little bit more, well, then why not exercise the options and you know, take possession of the shares and just let those dividends stack up. I mean, you know, if I could get the stock for almost for free, just for a little bit of upfront risk because I traded it like this, then, you know, I just take those shares and shuffle them over to a cash account and forget about it.
Right.
The other thing that I would consider doing is because the options chain only goes to 60, you're kind of limited about this kind of thing. But there's another move that you can do. Is you could go out here to the June, and I mean that's got some months to get there. But look at these, instead of buying those April whatever calls, look at these June 60s. I mean, these look pretty good to me. They look really juicy. If the stock runs up big
like hell.
and pulls these things, the idea is if they get to at the money, then, you know, now we're cooking with gas.
Right.
So, I mean, I would just nibble on these. If I get any of these, I'll just nibble on them. And I'm going to do it on down days. So, you know, that's how I do it. When I'm buying these out of the money options like this, I want to buy them while the uptrend is preserved on down days. So it's essentially like a dip buying thing. And
Yeah, I gotcha.
we had talked about this with the silver miners when silver went a lot lower and sort of like established a new range at lower prices. I actually rolled down on strikes with the so the equivalent here would be, you know, if I had accumulated a few of these 60s, you know, if the price were to reverse and go back and retest the lows of the breakout, I could roll the 60s down to 50, for example.
Right.
And I mean, you wouldn't do that now, but you could if these prices became a lot closer together. And so then when it bounces back harder. And you're burning up less on time decay because you've strengthened your position. It's better than adding contracts if there's a major price reversal.
Yeah. I feel you.
Yeah. All right. So that's a theme. Something else to go along with that theme is, look at this. U.S. Steel. A big move on this one. I got in this on Friday. I don't remember exactly the position I got in it, but I could tell you this. It's a swoosh position. So I built it the exact same way like what we just looked at with Camping World Holdings. I might have bought some out of the money stuff really far dated on the calendar. I don't remember. Like if the strikes go really high and you can go out far enough, then you know, you could get some good deals there. So X looks super strong. It's still got resistance here though at 24.5. but
Mm-hmm.
I'd be looking for just a runaway breakout. I don't
Well,
think that
okay.
this is going to consolidate. I think it's just going to keep
Why?
running.
Why
What's
would
that?
steel be going up?
Oh, this is a war. This is a wartime theme. In fact, that overlaps with the Camping World holdings too, because if a war breaks out, or any kind of like wartime tensions, people are going to go buy those kind of supplies. The price of
Hmm.
steel will skyrocket, and car makers like GM, which that was the next one on my list. I bought GM on Friday. Also, I found out that that guy Chaz Markley, he got into GM on Friday too.
Are you on GM now?
Yeah, I'm on GM, and
Sorry.
I got into GM also with a swoosh position, and I think I also maybe picked up some further dated out, like in 2022, some deep out of the money calls.
Uh-huh.
I don't remember if I got those or not, but anyway, yeah, I am in GM, and so like what happens in wartime with these kind of companies is, they get contracts for making Humvees and APCs and tanks and stuff like that. I
Right.
don't like that the war theme is really going nuts right now, but it is. So that guy Chaz Markley, he put on a really great trade. I was following along on Twitter. Hang on, let me bring up his tweets real quick, and I'll show this. I don't know if he's somebody that you follow or not. Do you follow
Mm-mm.
this guy?
No.
Okay. All right. Well, here, let me throw it up on the screen here. So altitude Chaz, and he's been telling a lot of stories. He's really excited about this new puppy. So that's a fun new thing in his life. So all right, here's what it is. ITA. He's been carrying a position in ITA that he got at much lower. In fact, I think one of these screenshots shows it. Is this it? Yeah, one of these is the aerospace and defense. Look at this. So he's got 142% gain on that. Pretty good. So let's look at ITA. He was talking about some liquidity issues with it. Yeah, beautiful breakout. I mean, that's a great looking trade. It looks like it's going to keep right on running, and I don't like that. I don't like buying these companies really. So what I'd be inclined to do is sort of like with the Camping World holdings, like go in there. So ITA, I don't know how much the options trade. It looks like it does a very thin volume. 386,000 shares traded on Friday. Well, here's the good news about it. You can come into ITA, and I don't know why Chaz didn't do this. Go in there and look at the holdings. And you can look at the big names in here, like Boeing. And look at the options on Boeing. They're super liquid. And it's 19% of that ETF. And
All right,
I don't
we're
have
on
to
to
buy
Boeing
Raytheon.
now?
That's the other thing. So, because I don't want to buy Raytheon. But yeah, look at this, man. Huge breakout in Boeing, too. So these wartime stocks are breaking out. It's not a good thing, but, you kind of have to like follow the money on this stuff, and you're not helping anybody if you're not making some money out of it, right? And so anyway, I'm trying to be picky about what I buy. I'd rather buy Boeing than Raytheon, for example. Mm-hmm. All right, so what else do I got to talk about? Oh, DraftKings. We got to talk about DraftKings, RIOT, and GME.
What is DraftKings?
DKNG.
DKNG.
Yeah, so what I like about this stock is it's so close to these all-time highs. It's like a blue sky scenario here. Yeah, I know we got a nasty wick on Friday. I was in this last week. What I had was I had a bull call spread expiring Friday. It was a 60.75, and I made quite a bit on it. And at one point, it looked like I was going to make an awful lot on it, but. Anyway, this was a trade that worked out pretty good for me last week. I closed out a little early, but not at the highs of that wick. Because I was really hoping it would, shoot all the way up to 75, and then I'd really be doing good.
Right.
So I'm going to be looking at a similar thing next week for DKNG. Let's go over there. I don't know why I had that position open, but... So it's at 71 right now. So if we look at some short dated stuff, let's make a call spread here. Let's do a 75. What, do we even want to cap it? I mean, geez, these things are so cheap out here. Let's see what a 75 looks like. Yeah, I like that. I mean, it could run up to 90 in a week, you know, and then you've got 10 times your money. I mean, who knows what it can do? I mean, take a look at Penn. So Penn's in the same group, and I mean, it's really moving. It's had some big moves. Looks like Penn might be a good one to get into also. I know that they just had some news about getting added to the S&P 500. So Penn's another blue sky scenario where it's just like up here at these highs. So if you look at this right here, an example of what can happen on these breakouts at new highs is take a look at this section right here. I mean, just in a couple of days, just this huge pop of 20% in a couple of days. 20% higher on DraftKings. Where does that put us? That put us at like 85 maybe, 80, 85, something like that. So maybe using some bull call spreads a little bit closer in would be good. Because I mean, what you don't want to do is if you put the call you're buying too far out of the money, then it just burns up real fast. That the price like drops on one day. But if you go with something like 72.80 maybe, what's that? Yeah, no, I like that less. Anyway, this is something I'm going to be looking at next week is DraftKings and Penn. How about Bitcoin? Big news over the weekend. People are saying it's 61,000 or something.
Got up to 61,200.
Yeah, so I had RIOT last week too. And that one really fizzled out. I was disappointed with that. I ended up making some money on it, but not anywhere near what I was hoping to make. So let's look at some RIOT options for next week. The range on RIOT, it's got a ceiling of about 80. You remember, Chris, when we were talking about this?
RIOT?
Yeah, where I said, look, you know, it can run up and hit resistance at around 80, this old high.
Yes.
And I put on that 60.75 when it was a lot lower. And that trade worked out, actually. I remember I said all it has to do is get to like 61, and then I'm golden. Well, it did that, and it actually went further. I closed it out like really at the perfect timing on Friday. I got
61. We were talking about the gap. Yeah.
Yeah. Right. So that was, I guess, a little over a week ago. Maybe we were talking about that. And I did put that trade on. And so for this week, you know, 80 is still going to be resistance. So what is a set? Look at how expensive these options are. When they're really expensive like this, this is when I like to use the bull call spreads on the short dated stuff instead of just the open-ended outright contract. And also because it's in a range. So the one I want to be selling is the 80. And the one I want to be buying, I don't know. Let's see here. What does it look like if I get a 70? So you could make 4-1 on your money on this. That's pretty juicy.
That's ridiculously expensive at the April monthly.
Yeah. Yeah, I mean, it's nothing for it to get here, though. It makes these kind of moves. And the other thing you can do is you can buy, what is it, 63? It's probably going to gap up to like 66. So you could buy one that's at the money and then sell one a little further out and just roll this thing up and keep rolling up as the price rises.
Right. I just don't. Okay. I just don't like when they add that much premium to a stock that they know is right. I mean, it's right in a consolidation area.
Yeah, I know. It's if I do anything, it's probably going to be this. put on like
Mhm.
a 66, 76, 10
Right.
points wide, try and get it for under 2.5. And if the stock keeps advancing, then I'll just keep rolling it up.
Right.
And so the idea is I want to keep my long option in the money, and I want to keep the option I'm short out of the money. And I can make the range wider too. So what that does is it reinvests profits back into the same trade by making it so that you can potentially make more. So
Right.
if I roll up to like a 70, 85, if I thought it could potentially hit 85, then the most it could be worth is 15 points instead of 10. So you can make a lot more. And if you're just rolling profits to pay for that difference about making it wider, then it makes sense to do. I actually did that with GameStop last week. So I mean, I could have made a lot of fucking money on GameStop, but
Right.
it stalled out. So I still walked away with something enough to roll into next week.
Hey, that works.
Yeah, exactly. So I've got a position in GameStop for next week. And one of the things that's really good about that is people getting stimulus check money, right?
Yeah.
They're gonna, if they're not out buying game consoles from GameStop, then they're probably buying GameStop shares, right? Like that's just what's going on right now. So I mean, this was kind of tough. I don't remember exactly what I have, but let's see here. I think it's this one. Yeah, this might be what I put on. 300, 350. It's either that or maybe what I got was a 350, 400. Yeah, this is what I got. I got the 350, 400. So it's pretty far out of the money, and I don't know what I'm going to do, but like if GameStop gaps down, then probably what I'm going to do is very quickly and aggressively be rolling this down.
Mhm.
Because what I don't want is the time decay on this option I'm long to burn up.
Right.
And it's really easy to do when it's out of the money like this. But this stock can gap up and clear through this stuff in no time at all.
Well, it's proven itself not to be a pump and dump.
Yeah, exactly. I mean, it looks to me like it wants to do we talk about the Volkswagen move.
Yeah.
It looks like it wants to do it. I mean, it's hanging on so strong at these price levels. And if you look at the range, like look at this. The ATR is 48 points. That's crazy. That's absolutely crazy because, I mean, it hasn't even been over $48 a share for all that long.
Right.
I mean, this is nuts. I think you got to be in GameStop because, and if you don't like paying up here, then take a look at it again on Wednesday. Just wait and let the time premiums burn up on this stuff and watch. The other thing to do is be watching these short-term charts, like a 10-minute chart and a 30-minute chart. These things will make bases. And, you can see really clear chart patterns sometimes.
Yeah. Well, I'm looking at the candle on the 10th.
Yeah. So Chris, here's how I was in this. All right. So what I had was a 250. Was it a 200, 250? And then that went into the money. No, I think it was what I had was I had a 250, 300. And then once that went into the money, I rolled up to a 300, 400. And I essentially got to roll into that for free, even though it's a more expensive combo, because I used the profits to do it.
Right.
However, the call I'm long is at a much higher price level, and so instead of banking profits, like rolling up a 50-point spread with bank profits, instead, by making that range wider, I made it so that it could be worth 100 points per combo instead of 50. So I could potentially make twice as much gains. So I like doing that.
Are you buying
because
options or are you buying the stock?
I'm buying. These are options. These are options combos. So to put it into perspective, a similar thing could happen next week. So say I have this combo on right here, a 350, 400. The whole thing's out of the money right now, right? This thing has to go up like, say, in order to get to 350, it's got to go up like 100 points, right? In order for
Uh-huh.
this call option to go into the money. Say it goes up 100 points. Well, what I'm going to do then is I'm going to roll this same combo. I'm going to roll it to like a 390, 490. Is probably what I'll end up doing. So I want an option that's slightly out of the money for the call when the stock is really running away to the upside.
Uh-huh.
And I want, another call option I'm short to be burning up time decay faster. It's just a way to control the time decay on the call option you're long.
Right.
So, that's how I'm thinking about it. Like, what am I long, and what can I use to like help slow down that time decay?
Right.
And so what this does is this is a much more effective way to trade these kind of stocks than what a lot of people are doing. A lot of people are coming in here. I mean, look at this volume on the 800 strike. Look at what people are doing. They're coming in here with $500 in their pocket and they're buying this thing. Well, what I'm showing you is, take your $500 here and put it onto something that actually can work, and you could still make huge money, and you could keep rolling it higher, and just keep that money in play. You could keep rolling it higher and higher and higher. But you're always in a scenario where you have a likely outcome of success instead of buying this garbage out here. So
this is 10 times, no, this is almost 15 times more expensive than Tesla on the options.
Oh, yeah. I mean, look at the implied volatility. It's like 340. And there's
Yeah,
30,000 open interest on the 800 strike. And these might pay one of these weeks. I don't know if it's going to be next week. Probably it won't because quad witching. But, go out the next week. Well, it doesn't have 800s. It has 690. Oh, my God. It has 690. And look, there's not even that many of them. Whoa, this is crazy.
What, the 30,000?
I'm looking at the open. Yeah, I'm looking at the open interest. That 30,000 is nuts.
Yeah, that's it.
And that's next week. So anyway, I mean, if they do ramp this stock to 800, I'm going to be rolling up every single day. And I'll capture most of that move. In fact, I might make as much or more than these people with the 800 call.
That's
And if it doesn't get anywhere near 800, I can still make a lot of money. So, I mean, I'll put it another way. Like, if you get into this thing for like $600, or say you pay the ask, okay, $765, which I didn't. I got in at midpoint.
right.
This thing has a return to risk of 5.5. So where I'm going with this, and that's at the ask. So you can make multiples on your money. Each combo will be worth $5,000 if this thing pays, and that's before you do any rolling. So
Yeah.
I mean, this is how to control the time decay and stuff like this. I mean, this 400 option, it's going to burn up fast. In fact, like, let's look at the 800. I want to look at the price chart on this thing because it has got to have.
What is that,
just
March
blown out
19,
so
800?
much. Huh?
I'm looking at the March 19, 800, right?
Yeah. I mean, so I got the chart of it open right now, and it's burned up so much time decay.
The chart of the strike?
Yeah, I'm looking at the 800 call option.
Okay, I'll let you pull that up.
Yeah, it should pop up in a minute for you.
Yes. Really? You came up that fast? Oh, because I'm watching you on YouTube, though.
Yeah. So if we zoom out on this, I mean, it's... Jeez, this is nuts. At one point, this was
like
$52. It was over $50 a contract at one point. Crazy. And now
What,
it's
the
$5.
800?
Yeah, the 800 strike. And now it's only $5. In fact, when GameStop started running again, these people had a nice run up, but now the money's burned back up from time decay. So that's what I'm talking about. Like, this is just not a good way to trade options.
15-minute. Okay.
I saw a discussion online where people were arguing about this, and somebody was like, "Well, if you don't like the 800 contract so much, why don't you just go sell a bunch of them short?"
Right.
And I mean, I don't think that's a good idea. But if you did want to do like iron condors on this thing, we could take a look at that. I did look at it actually, and the problem is that the bid-ask spreads are wide enough that it screws you on the iron condors. So, like, watch this. Say we do, let's do this the other way around. Instead of a bull call spread, we're going to look at an iron condor that is 50 points wide. I mean, the amount of margin you have to put up for this is
I
$5
think
grand.
this is going to get hammered. I'm sorry.
Yeah, I mean, look at that. The bid-ask spreads really suck on this. You have to put up $5 grand. I mean, it's and what are you gonna make? Like $500 maybe? I mean, I don't know. I'm not trying to sell options on this thing really. I mean, other than using those bull call spreads like we had talked about.
I don't see it going higher.
You don't think so?
I don't see it.
Well, here, let's zoom out. I mean, here's why I think it might. Because, I mean, when a stock has done something so incredible like what this thing has already just done,
Yeah.
there's no limit to it. I mean, the price can literally go anywhere.
Well, the thing,
There's a resistance level here.
it only did it because Wall Street bets. I mean, it's not based on fundamentals. It's not based on technicals. It's based on a bunch of kids behind computers
they're not
that
the
call
ones doing it.
call themselves apes and
Yeah,
retards.
I don't think
and
they're the
eating
ones doing it,
tendies
though.
and-
I mean, I think all their lunch money added together is a drop in the bucket for what's moving this stock.
Well, no, once the gamma squeeze hit and then the resulting short squeeze hit.
Well, I mean, Chris, look at the volume on this, man.
I am.
Yeah, I mean, the kids aren't doing this.
God, there's a lot of Wall Street Bets members.
Well, what is it, like 2 million or something?
I don't know.
I mean, look at the volume last week on this. The weekly volume was 228 million. So there's no way that they're doing that much. This is.
I got 25 million on Friday.
Yeah. I mean, there's no way all those Wall Street Bets traders are making $25 million worth of trades happen on this. I don't think so, but I mean, maybe I'm wrong. I mean, it's certainly a factor, but I mean, I don't think it's like really the factor. I will say this:
what these guys are doing is they're going into, because they couldn't get the shares, they're going into options to get the shares, and they're allowing them to be assigned.
Yeah. Well, it does look like it's running out of gas. We've got the momentum is slowing down. The volume was light on Thursday and Friday. It had that big smackdown on Wednesday. Like, it's kind of been halted in its tracks. So, if we don't have a big run up on Monday, I'm going to be rolling down in strikes on that position.
And earnings is on the 23rd.
Yeah, so it's not next week, it's the week after.
Yeah.
And so I bet you.
So that's going to add premium.
Yeah, but how much? Let's take a look at that.
An insane amount of premium is going to be added on top of the implied volatility that it's already got. So this could see implied volatility for earnings week, which would be April 1st, the April 1st expiration. That could go from 417 to 800.
Yeah.
Or 700.
Well, let me ask you this: like, do you think earnings is even really a material event here? I mean, it could be.
No, I don't think it's going to make a difference one way or the other. But I'm talking about the implied volatility solely.
Right.
That it's going to add that much more expected volatility over, because the implied volatility leads up into earnings, and then after earnings, that's it. Poof.
Yeah. Right.
The magic fairy comes along and takes it all away.
So it's 23rd, right? March 23rd?
Hold on a second. It is March 23rd after market.
Okay. So what I'm looking at right now is I made a combo here that is it's a long only, it's a bull call spread that's fully in the money. So
Right.
GameStop right now is oh, hang on, I did it wrong. The current price is 267. So let's go here to the 265 and sell it. And I'm going to go 50 points lower to 215 and buy that one. And now let's look at that. So this is fully in the money, but it's like at the money, right?
Mm-hmm.
And so if you bought this at the midpoint, if you could get this near the midpoint, what is that?
Oh, I'm sorry. I said April 1st. It's March 26th.
March
Very sorry.
26th is earnings?
No. March 23rd is earnings.
23rd,
I called out
yeah.
the April
Oh,
1st
okay. Yeah.
strike
So I'm
by
looking
accident.
I'm looking at a March 26th combo. And it looks like if you could get this thing for like maybe midpoint around $20. So what this is telling you is for an option bull call spread that's fully in the money, the price doesn't even have to go anywhere but sideways, and you can make more than 100% if you get it at the midpoint. I mean, that's pretty high. Let's see what it is right now. Let's compare that to March 19th. Don't do that to me. Sometimes
the calls
this thing craps
are
out.
way outweighed than the puts, though, on this thing, which is insane. They expect this thing to go up.
Yeah. Oh, yeah. The skew on this to the upside is nuts.
All right, so there was 16,700. There was 5% of 80 to 100 deltas bought. And then there was 19,000, which is 1%. No, I'm sorry, 3,000, which is 1% of the put deltas bought at the 80 to 100 strike, or the 80 to 100 delta.
I don't know what people are thinking with this 800 call option here, man. I mean, it's nuts.
Don't know. I don't have an 800 call option in the on the earnings.
Right. Yeah, you know what? Let's look at the open interest on March 26th because, if you go all the way down the options chain, there's not that much. There's only like 1,500 contracts open at 690.
For calls?
Yeah, calls.
Not. I got 1,000 strike in the calls.
Hey, Brian, are you still on the chat? Brian's chatting something. He says, I'm long TLT calls for July 150 strikes. I'll be poor next week. Brian, if you're still on the video, drop a message and we'll talk about the back spreads. I want to talk about back spreads in TLT. Anyway, sorry to interrupt, Chris.
No, that's fine. The 300 strike has like 1,300. No, I'm sorry, 1,800. That's it. That's the only one.
Yeah.
That's above 1,000.
You're right. I mean, like next week is it. Otherwise, this thing's a ghost town.
That's really strange. Well, you know what? Let me look at
It is very strange.
Let me look at the put side on the.
Yeah, I don't see much there either. So,
are these people retarded? Or they're just not wanting to get in early?
Dude, I don't know. Well, it could be, Chris, what's happening is...
Oh, there it is. 13,000. The $5 strike. That's stupid.
We're at the $5 strike?
Yeah. At the $5 strike on the put side, earnings week, there's 13,000.
Those might have been written a long time ago. But yeah, you're right. That's so weird.
2,000 of them were written on Friday.
Really?
Yep.
Well, look at how cheap they are. 3 cents.
Yeah, I know.
That's interesting. I'm looking at that like, maybe I want to get some of those.
Yeah. Yeah, I'd like to see where did this...
I mean, earnings isn't going to move
113.
Much,
What's the 113 at? That might be interesting.
Yeah, so
Uh,
lots of puts in there. So that guy Roaring Kitty, you've been
yeah,
following along with him, right?
yeah, I know him. I don't follow him.
So he has the April monthly expiration, I think, is when his calls expire.
April.
Yeah,
Okay.
and I think his strike is like, it's a really low strike. It's probably the 25 strike. I forget if it is, but I know he's got 500 contracts, so it's either the 25 or the 30 probably. I
Good
think it's the
God.
25.
That's insane.
Yeah.
It's so much at I can't even read how much it is.
For what?
I can't read how much the 25 strike is.
All right, so
200,
Brian's still on the call. He says I
247.15.
rolled
Okay,
in
I
and
got it.
down last Friday on TLT. Yeah, so by rolling in, the options get cheaper, which covers the cost of moving down. Okay, so that makes sense why you did that. So you're essentially trading off time in order for a better price. So, yeah, Brian, I don't know if you've seen the TLT position I have, but I used what's called a ratio back spread, and the ratio back spread, like if TLT drops, then I could essentially just roll down and for very low cost. It's just the little time decay I'm paying as I go. I'll show you real quick how I made that. And when I put that on, when I first put it
Hey,
on, what's
I'm
up,
very
Chris?
sorry. I need the bail.
Oh, okay. All right. Chris has to go. Adios,
Oh yeah,
Chris.
my
Any
son.
final words?
Uh, no. Good luck, y'all. Next
All
week.
right. See you next time.
I'm gonna be in the podcast tomorrow in the morning. Hit
On your
me up if you
stream?
feel like it.
Okay, yeah. So go check out
Yeah.
Chris's Twitter. He's got a link to his trading room. All right.
Yep.
Cool.
Thank you, John, for having me. I'm sorry.
Yeah, no problem. So catch you next time.
All right.
See you again soon.
Be good, guys.
All right, bye. So I want to walk through this TLT backspread real quick. And so I've been trying to keep enough time on it so that I could keep rolling. What I have now is what I originally had was the April monthly expiration, and I rolled it out, I think, to the April 30th expiration. And let's see here, TLT's 136. So I just rolled down again. And what I have is the calls. The way I have it looks like this. So I'm selling a deeper in the money option and buying an at the money option. That gives me a credit, which I then use to buy multiple calls, and they were, I think, 5 points higher, so it'd be like right here. Buy 3 of these, I think is what I had. Yeah, that looks about right. So when you look at this on the simulator, so TLT's just been backsliding lower and lower, and let me actually bump these out to 142s. Okay, that's a little better. So and let's also zoom out. So when TLT goes down, I'm just sliding along this line here. See if you notice right here, the P&L, like I don't really lose money when it goes down, just a tiny little bit. And actually, like the kill zone for me is if it starts to go up. Like now I'm in a zone where I'm hitting a lot of time decay. And so if you watch as I age this position, if we start cranking it through time, like I got plenty of time right now, but as you get closer to expiration, see how it's pulling down right around the current price of 130, right around there between 130 and 135. Really, the kill zone is right here between 130 and 136. Like that's not a good spot for me. But once it ramps, if it ramps into where these call options are clustered, and you don't have to put them all right on top of each other either. So another way you can do it is you can spread them out, but it makes it harder to roll. So I didn't spread these out across strikes, and but anyway, like this thing really starts making money fast if you get a big price spike. So at 150, things are looking pretty good for me, and at 160, it's really sweet, per combo, and keep in mind that the margin impact, it only costs $600 of margin to put this on. And then right here, if you get it at midpoint, you're actually getting a small credit instead of, like, this is showing a debit of 33. So anyway, for $600 down, and that's my entire risk is $600. I can make 10 times that if TLT ramps 20% in this amount of time. And through rolling, I can buy more time as I need to. So would you recommend selling like the 125 puts? Selling the 125 puts to, I guess you could, but I mean these aren't really trading for much. You're not going to collect much premium for doing that. So I mean, this is the way I'm playing it right now with this ratio back spread. It's been working so far. I've had a small amount of time decay. And by rolling, if you aggressively roll, if you essentially roll every week while the trade's not working, it keeps the time decay to a minimum. The one thing that you have to watch out for too, and another reason to keep rolling and keep it far out on the calendar, is when you're short a call like this, like the 130, TLT pays a dividend every single month, or at least it's most months. And when you're short a call that's in the money, it can get exercised on you. So I had this position on through the last dividend payment. It had like a month and a half of time on it. And so I did not get exercised on because it had so much time left on it. And the reason for that is if you look at the delta of this contract, where is it? Oh, this is still showing. No, that wasn't showing the combo. All right, so look at this from the point of view of someone who holds it. So this is April 30th. The delta at the current price, see how it's 0.76? Well, if that delta gets closer to 1, to where the dividend is bigger than the delta, that's when they're going to exercise it on you. I mean, it can happen otherwise, just at random, but it's very likely that they're going to exercise on you if the delta brings it. Essentially, if 1 minus the dividend amount is greater than 1 minus the delta, then they're likely to exercise on you. So that's a guideline that you can use. So if the dividend date is coming up, then and if you're short calls, you're going to want to watch the delta on the calls you're short and roll out to a calendar where the delta is lower. So for example, like if we look at the 130 that's like in May, the delta will be even lower. So yeah, 0.73 instead of 0.76. So the other thing you can do is as you go higher, the delta gets lower as well. So just for reference, like this has a delta of 0.43, so it drops off fast. Cool. All right. Anything else you guys want to talk about? I will mention that ratio back spreads can be pretty good on gold too, or like GLD. So GLD's in a similar situation where it's just dropped a lot. I've looked at doing this. It's just that I already have so much exposure to the metals with the silver miners. I mean, those are doing so much better. Like if you look at First Majestic, this is my biggest position. It's my biggest position in the miners. It's doing great. Like, it's holding up really well. Yeah, it didn't hold this breakout, but so what? Like, it's above all this support. But I mean, back to GLD. Like, the options in GLD are super liquid, and so you can do things like here. Let's play around with this a little bit. This will be fun. Let me get a GLD window open. Okay, and so sometimes I'll put on something like this. Current price is 162. And so what you can do is you could like sell the, or hang on, let me go back to the strategy builder. And so you could sell like a 160, which is in the money, and sell at the money. I'm sorry, sell in the money, buy at the money, and then that gives you a credit, which you can then use to buy calls. So you could do like, we've got about $1 credit. So remember how I said you could space these out? You don't have to cluster them all in one spot. So you can kind of make a stripe, lay down a stripe here. So let's look at a 164 and a 165. And so if you look, this trade can be executed for a small credit. What your cost is, you have to put up a margin of $200. And that's the most you can lose on this trade. Besides commission, right? And here's the way that it plays out is, you know, if GLD falls, I mean, you want to be aggressively maintaining this position because you only have a couple of days. See that time decay? It starts kicking in. And remember, like, the most you can lose is 200 at the end of the week, but it's got, the price has to move pretty far for it to work. However, if it does work, and when these things work, like they work big. So for $200 and almost no downside, just time decay, you can get a pretty big run here, return of like 4 to 1 on your money or more, and it's open ended. That's why it's a back spread. It's open ended, and you don't have to put the 165. You don't have to spend all of your credit. You can keep it as a credit so that. What that does is it makes the time decay work much more favorably for you. It doesn't change this picture here all that much about, you know, how much you stand to lose. It also makes a lot less money when you do it like that. And so, like, the more aggressive you buy these options, like here, let me clear this 164 off, and we'll look at we'll get 4 of these, 166 and a half. And so keep in mind, if you're not holding this until expiration, and probably you should not, you know, it can just make so much money without it even getting to your price, because these options have value when the price gets close to them, and so really, like, you're playing in this region underneath the dotted line, but above the solid line. And because I did it with only 5 days to go, there's not a whole lot of time there. But compare this to just buying a call straight up. Well, what's the difference? We can do that. Here's what this might look like. If we take off this part, and here, let's just clear all this out. And say that you just want to buy this. So that's fine. You could do that, but here's what you got to keep in mind. You're paying a debit to do it, and you know, if the price moves against you, you know, you're quickly wiped out. You don't have much to work with. And so in this one, we're not paying very much. You know, like, it's not much is risked there, but like if you were to buy like I don't know, like a 164. So this has the time decay problems of the back spread, but if the price goes down, like, you're very quickly losing the debit that you put up. So that's really the difference. I've used these quite successfully on stocks like Beyond, for example. So let me show what Beyond did recently, because I was in it, and I got a really, really a great gain out of it. is right here on this gap up. I was carrying a 2-week long ratio back spread, and I sold it right into this gap up because, I mean, this stock is famous for coming out with news and then they just like sell off after the headline. So I was hoping Beyond would trade a lot more like that Monster Energy drink shares. I mean, I think that maybe the potential's there, but they're not quite doing brand building the way that they could be. I don't know. They talk about deals with McDonald's and Taco Bell and all that stuff, but for some reason these shares don't have a whole ton of traction. So anyway, I saw it trading tight and do this bottoming thing. So I put that back spread on, and I got really lucky with the timing on it. And I can show how I might build that and Beyond. Once you play around with these a little bit, you get a feel for it, and you can easily build them. What is it called when you have that trade where you're buying 3 out of the money, selling 1 in the money, and buying 1 at the money? That is a ratio back spread, is what that's called. And by the way, this book right here, Options as a Strategic Investment by Lawrence G. McMillan, he talks about back spreads and ratio spreads in this book. And so if you put together a lot of the concepts that he's talking about, you can build these. So if you want to study about it, that's a great resource for doing that. I absolutely loved reading that book. In fact, there are still some chapters I haven't read in it, but I've read a lot of it in several times. It's one of those books you just keep coming back to. All right, so Beyond. Current price is 143, let's say. And so I'm going to go with 2 weeks out on this one, so that we essentially have like a week of time to see if we like the trade or not. And if these things go way into the money, you can ride them all the way till the end, but it's risky to do that. So you want to make sure that week 1 goes really well. And if it doesn't go really well, then you probably want to close it out, or maybe roll it out or something. All right, so where were we at? 143. Okay, so that's what we're gonna buy. Oops, I always do that. Strategy builder. This should be the default. Okay, buying a 143. And so something else to note, interesting about this, is however many points away I pick is what my margin requirement is going to be. So if I put it 5 points away, for each combo, my margin requirement is going to be 5. And the reason is, if you just sold this call naked, you'll see the let me get that off of there. So if I just sell that, is it going to show me? No, that's okay. So let me just cover this. So the margin impact is 500. If I move it to where it's 6 points apart, so I'm going to go from 143 to 144. Now the margin requirement is 600, because it's just looking at the difference. It's like you have open-ended losses on this call that you sold if the price rises until you hit this other call that you're long, and then they net out. So the broker isn't worried about it then. So anyway, once we have this sort of credit built here, then we can look and kind of guess the midpoint there. Let's just say $2.70 or something, just under $3. And you can come pick a call that you want to buy, like maybe or one or more calls. So if I do it like this, it's a back spread. But however, if I do a ratio, so take this price and divide it by 2, that gets us like $1.44. Say I buy 2 of these 165s instead. And these can work out better or not. It just depends on a lot of factors. You can have higher time decay on this one than you will on the if you went with one of these 155s. But the potential profit can be much bigger here. And so, I had this a position like this on in Beyond when it did this gap up. And so I mean, it was huge gains. I think I didn't have it as a ratio though. I think I just had it as a regular back spread, and so it looks something like this. So you can catch these big overnight moves though, like this, and you could do it with very little risk, because if it gaps down, you're not really hurt. And so if I push this call just a little bit further out of the money, well, let's go just a little further out again. What I'm trying to do is make it appear as a credit. So now it appears as a credit. And so again, like this is the danger zone right in here where you'll experience a lot of time decay. The other thing you have to watch out for is if it gets all the way up here and you think, oh, that's great, but if it backslides, it comes back down even harder. So the backswing on this is brutal, because look, it's falling all the way down into this this bucket. So the point is, like, the more time you try to have with these, the wider this bucket is going to be if you build them this way. So that's why with the gold one, we were able to build it really narrow, because we were looking at only 1 week of time. But when we look at 2 weeks, it looks like this. The thing I like about 2 weeks is you can put this on, and like if the stock starts running really good, and it crosses over that chasm in the first week, and stocks do that sometimes, you can just really let it run for week 2. All right, let's see here. What is the chat? The first channel I found where someone goes really deep into their personal options trades. Yeah, I know. That's why I started this channel, because I wasn't able to be expressive enough on Twitter. And so I started putting a lot of my ideas here instead. And yeah, there's so much creativity that you can put into it. And Brian, if you ever want to come on as a guest, we can chat back and forth on here and kick around ideas. If you're into the options trading, it'd be fun to have you as a guest. Let's say you're deep in the money in an overnight gap up. How would you start closing out that ratio back spread? So a few things you could do. You can roll the entire thing up, but what you may run into with that is if the implied volatility is large, then the ratio back spreads aren't as good. So what you can do though is you could just roll up the calls. So here, let me rebuild it again. Yeah, I mean, it essentially comes down to rolling. You can roll this section of it up, and you can roll just this part of it up if you want. But I mean, if you're nervous, then maybe take off contracts or close it out. Yeah, I mean, a lot of times with the gap up, because the implied volatility is so big, and when implied volatility rises, this becomes a lot more valuable. So, I'm selling into that a lot of times. I'm closing these out. Yeah, and I don't leg out of them either, though. I mean, I might roll around this, the call, the call or multiple calls that are out here, but I'm not like legging out of this thing, like closing out this. Any of the long calls and leaving the short call. Hey, I'll show you another one that's really cool. So I don't find this written about anywhere. And a friend of mine came up with the name for this. We call it the drogue trade, or it's a drogue position. And I'll show why he thought of that name. So here's where the name comes from. Oops. It comes from, in boats and planes, it's a parachute. And if you find yourself going in the wrong direction on a boat, then you can deploy the drogue or a plane, and it'll help pull you into the right direction. So, or it'll slow you down from going in the wrong direction, really is the idea. So let me show you the drogue position. And let's look at it on Tesla. And so there are good times to use this and bad times to use it. And also, it's a little dangerous because if you don't actively manage the position and you just kind of like let the clock run out, you'll find yourself naked short a call. So you have to be very careful with it. Is it going to load Tesla for us? Well, if Beyond is still working, yeah, we can just use Beyond. Okay, so here's a drogue trade. It's where we buy. Oh no, it looks like the platform is gone. All right, well, I could talk through it anyway, and maybe the platform will come back. So the idea here is, with not a whole lot of time left to go, like maybe 1 week to go, we would buy an out-of-the-money call here. And we would sell with about 3 times the duration. So maybe like 3 weeks out, we would sell a call that is worth maybe slightly more than the call that we bought to create a situation where we have a small credit. And what you'll find is that the this like April 1 call that we sold, it's way far out of the money. So it's burning up time decay really fast. About at the same speed as the time decay is burning up on the call that you're long. And so if the price falls, they both get wrecked. But if the price zooms up, then the call that is short dated is going to zoom higher a lot faster than the call with more time on it. So it's really cool in that way. The problem is it doesn't have a whole lot of time generally for these to play out. And another drawback is that the margin requirement is very high, because the call you're long does not count as protection for the call that you're short. And so there's a trick you can use by going way out of the money and trying to like buy a call there to try to cap the margin requirement. But yeah, I'll try and get into that on another show where we might be done here if IB is done. So yeah, all right. Well, hey, thanks everybody for watching. Hit like button, please. Subscribe and share the video with. This is going to be posted to Twitter as a replay, and so you can help me get the word out on this channel. So and also just contact me on Twitter if you ever want to be a guest on the show. So all right, thanks everybody. Bye.